All right, guys, can everybody hear me okay? I'd rather not use the microphone if I don't have to. And I think we have some people on Zoom as well, so I'm gonna go and get started. It's a few minutes after 12, and I know we want to try to be done by 1 o'clock. Appreciate everyone coming in today. My name is James McIngvale, and I own an accounting firm here in South Haven, and work with several of you who are in here already. I've got a pretty good real estate background. I tried to sell it, years and years ago, and if I'd been any good at that, I wouldn't have an accounting firm. But I found out I was better at taxes than selling real estate. Today I prefer to keep it informal. Happy to answer questions as we go. But generally speaking, I'm providing kind of a general overview about how you're taxed, because I don't know who's new in here relative to selling real estate and who's not. We'll go into some specifics around COVID tax provisions that may still be in place, may have expired. We'll also talk about some tax planning strategies. Please know what I talk about is not one size fits all by any means. If you want to come out of here saying, how exactly should I set myself up? It varies based on your situation. But I do want to at least try to give you guys some general insights and overview about how you're taxed, what tax strategies you could consider, and answer any questions you might have. So with that, I'm going to go ahead and start. Let's see. Tommy, do you think I have to clear this before it'll let me advance this Zoom? No. Nope. Okay. Guys, give me a second here. It was working just a second ago. Does this power on separately or no? Just power on whenever it's plugged in. Yeah, none of the arrows are working on this.
I don't know taxes, but I know computers. So.
We'll make a good team.
Okay, that works. And I can advance it manually if I need to. It worked there. Okay. All right, good deal.
All right, guys, just as a general overview, income taxes right now, most everyone here either lives or works or both in Mississippi. So 5% Mississippi income tax, and the IRS is up to 37%. So that's just your income tax. Most everyone in here is what's called an independent contractor and subject to self-employment tax, which consists of two parts: Social Security and Medicare. Social Security is 12.4%. Medicare is 2.9%. So now Social Security caps at about $147,000 this year. So once you make above that, you're not Social Security any longer. But you can see just from this screen here that your real estate income can be taxed. I'm not going to go as high as, but it's not uncommon to see a 40% tax rate. And oddly enough, once you hit that Social Security cap, you actually get a pay raise because you're taxed at a lower rate because you're no longer paying that 12.4% Social Security. So, and you're taxed on net earnings after business deductions. So what I mean by that is your income tax is figured after you take account property taxes, houses, charitable giving. Your real estate income only includes your income after business expenses. So you don't get any personal deductions as a means of trying to lower your self-employment. It's only your business deductions. So what we always tell our clients is we want to get that real estate income as low as we can. For obvious reasons, but one of them is that real estate income is taxed at a higher rate than other sources you might have, and that can be 40 to 45%. In terms of COVID-related tax news, we're in our second year of tax stimulus related to COVID. Last year was our second year. We're, I guess, in our third year now. So I'm going to touch on some of these. This was more relevant this time last year because a lot of the initial stimulus you qualified for was passed in 2020, but there was carryover into 2021. One of them is PPP, which some of you may have received in 2020. We actually have clients who got it in 2021 as well. That is not taxable. So if you received a PPP loan in 2021 that was forgiven, it's not taxable.
What does PPP stand for?
Oh my gosh, I knew you were going to ask me that. I knew a year ago. No one's getting it right now, but it's payroll performance. I don't remember. I'll have to look that up. I'm sorry. But basically what it was payroll protection, something or other. But what it was is basically for someone who was self-employed, it was a government stimulus plan that would give you up to 2 months of your self-employment earnings with a cap. It was a great program. Most of our clients took advantage of it, but there was a lot of unknown about it, including whether it's going to be taxed or not. And it wasn't until December of 2020 that Congress finally passed rulings that basically made it exempt from taxes. Unemployment benefits, and again, you may not have seen or received any of this last year. We certainly had a lot of clients receive it in 2020. Those are taxable. So PPP is not, unemployment is. In 2020, they also allowed taxpayers to pull out retirement income without having a 10% penalty. So if you had qualified under, whether you were sick, you had a family member who was sick, you had financial hardships, you could pull money out of a 401k or an IRA or a SEP and not pay a 10% penalty tax that typically applies if you're under the age of 59 and a half. The other provision of that was you could repay that over 3 years. Usually you have to, I'm sorry, not repay, you could be taxed on it over 3 years. Usually you have to claim that income in the year it's received. I only have this up here because no one was eligible to pull it out in 2021. But if you did in 2020, and you chose to defer your taxes on it over a 3-year period, 2021 will be your second year repayment on it. So we'll have clients who did that, had taxes withheld, they'll forget they owe a third of their retirement income back this year as income, and it's going to hit tax returns. I've got here possible reduction in self-employment taxes for COVID-related quarantines. Those will relate to sickness in your house, whether it's you or a family member, or as a form of layoff. Those expired in 2021, but you as self-employed contractors, if you were sick and missed time, if you had a family member in your household who was sick at this time, you can potentially lower your self-employment tax when filing this year's tax returns for a certain amount of time you missed related to COVID. Of course, there's caps with everything, but that is one valuable benefit that's still out there. This one here I want to touch on. You know, we had stimulus money coming out in 2020. We actually had 2 more rounds of it last year. Then there was this advanced child tax credit. Now, if you don't have kids, obviously this doesn't apply. But yes, sir.
What is that possible reduction of self-employment taxes on COVID? Like, you know, we paid like 15.5 or something.
It's which question, sir?
How do you reduce it?
You get a credit for the number of days you were out based on your earnings. It's a very complicated calculation, but let's say your average earnings per day is $250. You get to reduce your self-employment tax by the number of days you miss. That's capped at about 14 days or so.
Oh, okay. So it's a specific form you have to use?
Yes, there is. Advanced child tax credit. I'm bringing this up because about mid-year last year, the Biden administration passed an advanced child tax credit. On top of a normal tax credit, you may already be receiving for your kids who are 16 years and younger. They actually started depositing some of that money into taxpayers' bank accounts, or some taxpayers were receiving checks for it. That money, unlike other stimulus, that has to be repaid if you receive too much. So on this year's tax return that you'll file this spring or summer that relates to last year's income, you will have to disclose any advanced child tax credits you received to determine whether or not you received more than you should have. And then if you did, you have to repay it. That won't apply to a lot of people. The income threshold for that's about $150,000 and above. But that's something that whether you use an accountant, TurboTax, you're going to have to know the amount of that child tax credit you received last year, because it will have to be reported on your tax return. You may be eligible for more, but in many cases, you may have to pay some of that back.
Actually, we have to look at the deposit, whatever.
Yes, you would need to look at deposits. The government will not be sitting out a tax form for you on that. You'll have to know it yourself. You can either log on to the IRS or set up an account. In fact, you could have done that last year and opted out. It was easier to work for the FBI than to establish one of those accounts. It seemed like the amount of ID verification they had to go through was crazy. So we told a lot of our clients, don't spend it, and if you owe it back, you'll just have it set aside. But you can log on to the IRS, get that information, but we're telling our clients you're gonna have to go check your bank accounts and see what deposits you may have received. A big change that actually passed last year that could help you guys relates to meals expenses. Now, a little history. Meals generally are only deductible up to 50% of the meal cost. So if you take a client out for lunch and you spend $20, only $10 of that is normally deductible. Last year, the Trump administration, before they left, passed a provision that allowed meals for 2021 and this year in 2022 to be 100% deductible, fully deductible, with a caveat that it has to be purchased at a restaurant. So you may ask, why would you purchase at a restaurant? Well, if you host clients at your house and you go to Kroger and you buy groceries to do that, you're still limited to 50%. If you go do catering at Corky's and bring it to your house, that's considered purchase at a restaurant, you get to deduct 100%. I've got several examples up here. I do want to touch on before I get into some of these. Entertainment is still not deductible. So if you take a client golfing or to an Ole Miss football game, that's not deductible. But if you buy meals at the game or on the golf course, that is deductible. So here's a few examples. Restaurant meals with clients and prospects, 100%. Entertainment, just like I said, 0. Employee meals for convenience of employers served by in-house cafeteria. Okay, so an example that may not apply here, but during tax season, I bring in dinners often for my staff because we're working till 9 or 10 o'clock a lot of times. If I bring in that meal from Corky's, I get to deduct 100% of it. If for some reason we decide to bring in crock pots and cook it ourselves, which won't happen the way I cook, but if we did, that's only 50% deductible. Meals served at a business meeting, that's deductible 100%. Year-end party for employees and spouses, 100% deductible. Meals at a marketing presentation. So for instance, this meal being served by the board of realtors is 100% deductible. Those are some examples. That's a big win because I know you guys are oftentimes eating out yourself while you're showing houses or prospecting or whatever. You're taking clients out. As long as it's at a restaurant, that's 100% deductible for you. Taxol revision back to 2018. Forgive me for going fast. There's a lot of content we need to cover here, but basically, why am I jumping backwards? Well, because this Taxol provision or revision, particularly for you who are new in the room, was the most business-friendly tax law restatement that I've ever seen since I've been working in this. I've been doing this for about 20 years or so. It lowered tax rates and expanded the tax bracket. So what do I mean by that? It meant that you had to earn more money before you would graduate to the next tax rate. No entertainment, which I talked about. So entertainment was no longer deductible. That was a loss for us. Capital and state income taxes. That's tough for us who live in Mississippi and have property taxes and income tax. You can only deduct up to $10,000 of that combined on your personal return. That doesn't count rental property or something you may have property taxes with that. So that was the loss. But this one here, this provision, qualified business income deduction. Basically what passed at that point was that you have the opportunity to exclude up to 20% of your earnings from income tax. Now remember, the first slide I showed you income tax and self-employment tax. This doesn't apply to self-employment tax, only income tax. But that can be, on average, 20 to 25% that the government will basically say that 20% of your income is not taxable. Like any tax law, and I guess I should be grateful, they make it as complicated as can be. The purpose of this here is just to kind of give you an overview of things to think about. But basically, it phases out based on income. It's not eligible to all groups of employees. Realtors, property managers, real estate brokers are absolutely eligible for this. So it's something that if you have been working in the industry, you've likely been taking advantage of. If you're new to the industry, you basically have an opportunity to exclude up to 20% of your earnings. So what can we do? What can we do as realtors? Some of these are pretty basic, but one of the things we say is make sure you know what's deductible and are tracking it and taking advantage of every opportunity. A lot of these are obvious. Advertising, brokerage fees, cell phones, office supplies, your E&O insurance. Sometimes your broker pays that, but it may be included on your 1099. So you don't actually write a check for it, but it's added to your income. You want to make sure you get that amount of deducted. Office rent, client gifts. You know, I'll touch on this real quick. The client gifts, I think there's like a $50 cap on it. You know, that's not heavily scrutinized. I'll just leave that. Draw your own conclusion from that, but that's one of those areas where I would say, you know, don't hesitate to try to deduct those. Continuing education, although the board's offered free education, you may be going to Destin for a conference or something. That's deductible. Accounting fees, fully deductible. It's fully deductible. You pay me, it's fully deductible.
Can I ask you?
Yes, ma'am.
Well, you might.
No, I'll go back.
Home office. So of course, you know, most of us all have offices or the brokers, but a lot of us work from home.
Right.
So can you a percentage of your home or whatever?
I'm glad you asked. Let me talk about that. So you're ahead of us here. No, absolutely you can. You have to be careful because I'll say this, we have not found in the history of working with our clients that a home office, it's one everyone knows about, but it doesn't generate tremendous value. And part of it is because you're limited to a percentage of your home. So if you have a 2,500 square foot home and you've got 10 by 10 rooms, so 100 square feet, then you're eligible for 1/25 of that home's expenses. Mortgage interest, property taxes, homeowner insurance, utilities. It's prorated basically based on the percentage of the office of the home. Ends up being more valuable for someone who might be a plumber, for instance, who has a shop attached to their house or something like that. But basically, it's not tremendously valuable. But if you have a dedicated internet line in your house, or part of your internet is used for business. I mean, I've got kids who are streaming stuff, they're in school, but I deduct half my internet because I can tell you what I'm using at the house. Like yesterday, I worked from home. All of our internet was going to support my business. So that's separate from a home office, internet, a cell phone, or obviously cell phone, but a landline, a fax line. But the actual home office expense includes the deductions I just talked about. We can see deductions for up to about $1,000 to $1,500 for that, which is great. Every dollar helps, but it's not one that moves the needle dramatically. But I would encourage you certainly, even if you have an office with your broker. I know you guys, again, I'm a fan of one of you. I know that you work out of your car a lot. Your car really is your office as much as anything. But particularly with COVID the last few years, you probably work out of your house more than ever before. And, or with technology now, it's easier to work out of your house than ever before. You don't need that desk at the broker's as much. Track those expenses and see if it's a good deduction for you. I also get questions on that. Is that a red flag? It's not. I've never had anyone audited because of a home office. So those are the two things. Everyone seems to know about it. Everyone thinks it's a red flag. It's not. If it's legit expenses, it's legit expenses. Yeah, Jeff.
Is that factored back in when you go to sell your home?
Good question. It's not, because it's a part of your home. So where Jeff, I think, is going with this is you can sell your home and exclude up to $250,000 gain if you're single, $500,000 if you're married. So $500,000 of potential in your personal house, if you sell it under certain conditions, it's taxable. I think what you're asking is if we use part of that for our house, is that part of the house taxable? It's not. A real good question. If you had an attached shop, yeah, in that case, but with it being attached to your house, it's not something we have to back out.
Hey, James.
Yes, Amy.
While you're on that subject, is it still 2 years that they have to use it out of the last for their primary residence?
Two out of the last 5 years. Yeah, now there's certain exceptions for military moves or hardship moves, but generally speaking, the general rule is 2 out of the previous 5 years. Yeah. Meals we talked about, entertainment we talked about. I have this here for you guys. Paying for repairs and expenses to facilitate a closing. Don't know if anyone here has ever done that. I know I've seen it with my clients, so. If that's why my clients.
Is that a joke?
No. It is a joke.
Are you asking?
Yeah, I know everyone, if you haven't done it, you will. So that is deductible. We consider that a cost of selling the house. So that is deductible. That's why I had that on here. And if I didn't mention that accounting fees are deductible, they are. So vehicles, maybe your biggest deduction opportunity. Oftentimes it is for our realtors. I've got up here, there's several ways of deducting a vehicle. You can take mileage, you can take the actual cost of the vehicle, you can lease the vehicle. I have mileage up here because that's probably what 75% of our realtor clients do. And I've got up here the mileage rates. In 2021, so last year, 56 cents a mile is what you get. So if you drive 10,000 miles, that's a $5,600 write-off. This year, as everyone knows, gas has bumped up in price. They bumped up the mileage reimbursement to 58.5 cents. So how do you track it? Well, you got GPS on your phone. We have a lot of clients who have calendars. We have a lot of clients who are beginning and ending mileage, and they say we take 75% of it. We let all things go. If you are audited, they're going to want to see a mileage log of some sort. So I've got to stand up here and encourage you to either get a GPS app to track it, do paper or whatever. But I'll be honest with you, a lot of people just kind of hand out a number and that's what they get. I've never had that audited. I've never had that trigger at all. So
What about the gas receipts?
gas receipts don't help you with mileage because They don't, the IRS would know whether the gas receipt was related to a business opportunity or not. So that's why mileage log, saying I started here, I drove here, and this was how many miles is more easily defensible. Leasing, you can lease a vehicle. I personally have not found that to be as valuable as the other two. So you lease it, you enter into a 3-year lease for a vehicle, you can deduct a portion of the lease payments that are attributed to business. On top of that, you're still eligible to deduct gas, maintenance, etc. You can't do both. You can't take mileage and lease them. You can only do one or the other. Same thing with depreciation is what I have up here. It's cost of the vehicle. We'll have many clients go buy a large SUV, for instance, or a truck. Last year, if you're able to find one last year, and you can deduct that vehicle over the cost of it over 5 years, but you also, under certain circumstances, have the ability to deduct up to 100% of that cost the first year. So if you had a killer year last year, and at the end of the year, you decided to go get a Toyota 4Runner or something like that, you need to look at it, talk to your accountant, and see if it makes sense to deduct the cost of that vehicle in its entirety last year. Now, the good thing about that is you'll be real happy with the tax benefits of doing that first year. The bad thing is it lowers your deductions the next few years. If you deduct the cost of the vehicle, you also still, through depreciation, you can also still deduct actual costs such as gas, insurance, maintenance, etc. I have recapture up here though. Oh, one more reminder. Again, if you deduct the cost of the vehicle, you can't take mileage. It's an either or, and it's by vehicle. So you could have a vehicle you drove and took mileage on January through June, and you buy a new vehicle and decide to deduct the actual cost. You can do that because you had 2 vehicles. You can only deduct one method though under one vehicle. So once you switch the cost, you can't go back and forth to mileage. Recapture is a tax term that basically means if you deduct the cost of your vehicle and then you go trade it in 2 or 3 years later, you have to claim that trade-in value as income. So back to my 4Runner example, if you bought a 4Runner last year for $40,000 and you wrote it off in its entirety last year, and then you go trade it in 2023 and you get $30,000 back, you have to claim that $30,000 back as income. Oftentimes our clients had that offset by the cost of the replacement vehicle, but just know that we don't recommend the 1-year write-off unless clients are pretty wedded to keeping a vehicle 4 or 5 years. And the only reason for that is the vehicle becomes less valuable, the trade-in is less punitive. We have clients that want to flip vehicles every year or 2. We do not do the accelerated write-off for them. We tell them to stick to mileage in that case.
So you write it off for 2021, use mileage in 2022?
No, you're not able to switch.
Okay.
That vehicle's
From then on?
from then on. That's right. Any questions about vehicles?
Electric vehicle, no gas now, how you gonna do that?
You can write off the cost of the electric vehicle and you're still driving mileage. I mean, so the mileage rate still applies. Okay, guys, it's been very dry so far. This may not help it, but every once in a while I like to sprinkle in a joke to try to keep myself awake, if nothing else. So, and this is me to you here. If an accountant's wife can't sleep, what does she do? First quiz question here. She says, honey, tell me about your day. And then have you heard the interesting story about an accountant?
No.
I haven't either. There isn't one, so. Okay. So that's the best I got, guys. I'm an accountant. That's all. So we've covered some of what you're eligible for, your deductions, how you're taxed. I want to jump a little bit into tax planning ideas and opportunities. These aren't all real estate specific. These aren't a fit for everyone, but these are ideas that we do talk to some of our clients, anyone who wants to talk about in terms of how it might improve how they're taxed. A lot of these ideas work against each other. You may do one and it hurts your ability to do another. That's why I say it's not a one size fits all. Probably the biggest one, and this isn't just for realtors, this is for any sort of contractor or someone who has their own business, is the S corporation. So what we'll do oftentimes is we'll suggest to our clients you form an LLC in the state of Mississippi. We say LLCs, we're not attorneys. Let me say that for the record. But generally speaking, LLCs are cheap. $50 to form it in Mississippi, no annual renewal fee, and they're flexible. You can, once you form an LLC, you can be taxed any number of ways. Well, once you form that LLC, you can then tell the IRS, we want it taxed like an S corporation. What the S corporation does is it minimizes your self-employment tax. So that 15% or so in self-employment tax, which was Social Security and Medicare, that just hammers you as an independent contractor, it can go away completely if that income is run through an S corporation. So if you're a broker, instead of issuing a 1099 and paying James McIngvale, issues it to James McIngvale LLC, taxes an S corp, I could save in theory 12 or 15%, up to 15% on all of that income. It also offers the opportunity to participate in some different retirement plans, if you're interested in that, than what you might be eligible to participate in as just a sole proprietor or independent contractor. So disadvantages, although you're eligible for some retirement plans, you're limited on others. Interaction with the QBI deduction. As a reminder, that QBI deduction is that 20% income exclusion I talked about earlier, that you, it's more easily attainable, that 20% as an independent contractor, sole proprietor, than it is to the S corp. So it can limit that opportunity. The other thing is I have payroll compliance implications here. So believe it or not, that rule I just mentioned about limiting self-employment tax, the IRS is aware of that. And so what they don't want to see are individuals setting up S corporations just to avoid self-employment tax. That's illegal. So what we recommend to our clients is that they consider adding themselves to payroll, paying themselves as an employee. So they have this LLC, they're the owner of it, they're also an employee of it. Well, when you pay yourself on payroll, as anyone knows who's ever worked for someone else and gotten a W-2, you're paying in Social Security and Medicare, and your employer has to match it. Well, if you're the employer, you're matching yourself. So with that Social Security and Medicare you pay in as an employee is basically equal to what you're saving. The more you pay in payroll, the less this saves. But the IRS wants to make sure you are not just essentially avoiding taxes and taking advantage of this rule. So I say this to say, basically, you got to be careful in this payroll issue. IRS wants to see it, but the question becomes, how much payroll do you pay? Well, if you're a sole proprietor, you're making $100,000 a year after expenses, and you set up an S corp and you pay yourself $100,000 in payroll, you save no money. All you've done is make your accountant happy because he's filing an extra tax return. But if you set up an S corporation and instead of paying yourself the $100,000 in payroll, you pay yourself $50,000, then you still have $50,000 that you're saving 15% on. And I think that's about $7,500 in tax savings. And all you've done is route the money through an S corp. You haven't changed anything or else. Yes, ma'am.
And how much did you say that typically costs to get set up?
Well, you can set up an LLC in Mississippi. Now, this is if an attorney's not involved. If you do it yourself, you need a tax ID number with the IRS, which is free. Okay, you need
Where do you go to do that?
you can get that on irs.gov,
IRS?
and then you can set up an LLC with the state of Mississippi,
Okay.
and that's $50. If you use an attorney, it's gonna be a lot more expensive. We have someone we've recommended to our clients who's not an attorney, but he'll set them up for you and he's a lot cheaper.
James, I have to interject and tell you, it's $476, and that guy named Ted Crowder that will set up the whole thing. He'll set up your operating agreement, get you your tax ID number, and he just hands it to you in a
Do you
packet.
feel like you're better doing that instead of the IRS?
Yes,
Okay, because it saves you a lot of time and, okay.
it's cheaper than an attorney.
Thank you.
I'll share the
Thank
number.
you.
And I need to tell them to start giving me kickbacks. Because I've sent them more business.
But you can do it all in about 10 minutes.
You can do
Every
it
bit
yourself
of it
without
all in about 10
tenants, and you can even do an operating agreement on LegalZoom. Now, why do you need an operating agreement? Most of these LLCs are one owner LLCs. I think having an operating agreement is asinine personally, because you're liable for everything, you're gonna get everything if it dissolves, or you're gonna have to pay everything if you owe it. But banks want to see an operating agreement usually before they set up a bank account. So usually you're having to get the operating agreement. Yes, ma'am.
I have an S corp, and the way my accountant has me using this, I'm an employee, I have W-2 of my S corp, but, so I have a payroll, adequate payroll, and the rest of it just goes into the S corp, but he's pretty particular with me, like, I can't use that S corp money unless it's really legitimately business expenses, so if I need extra money for something,
Mhm.
I'm taking a loan out,
Mhm.
or I'm taking an extra payroll, or paying taxes on it.
Yeah, and again, I'm gonna tell you what I do, and I haven't gotten in trouble, and I think it's right. I don't agree with that.
Okay.
Okay, because see, when you own that S corp, you're an employee, and I'm glad you brought this up because I wanted to touch on it anyway. So the question is, what happened, and I forgot, I got to restate questions for people on Zoom, they can't hear, I'm sorry. So, the question was, do you have, what, can you, essentially, can you use the funds from an S corp that aren't all run through payroll? In other words, can you pull that money out personally? And the answer, in my opinion, is yes. You can have payroll, because you're an employee, but you're also the owner. So you can pay the excess of that out as what's a dividend or distribution. You're taxed on it all anyway. And what I mean by that is payroll is deductible by the S corp, but it's included on your personal return. So you're getting taxed on it there. Whatever profits left over after payroll, that's being taxed on your personal return anyway. And I do need to say, this is called a flow through entity, meaning it doesn't pay any tax itself. Everything comes to your personal return. So my whole thinking is, well, hell, if I'm being taxed on it anyway, I want it, you know, and even though I own the S corp, I don't want to feel like I can only get that money out through a loan or something like that. The IRS has no problem with it. What the IRS wants to see is a reasonable level of compensation. And that's highly subjective. Now, you can go do market studies, but what should payroll be for a realtor out of an LLC? Well, that depends on productivity, what their role is. I mean, you know, that is a highly debatable. It's not like it's a flat rate, in other words. I usually recommend someone who might have an S corp and they have other employees, make sure you're the highest paid employee if your production justifies it. But you're also assuming management obligations as well.
And risk.
And risk. But you're in a highly volatile industry. Maybe not month to month, although I'm sure it can be. But certainly year to year. Compare 2017 to what you did the last 2 or 3 years. You know, it's probably like a different world from what I'm hearing. But to answer your questions, you can pull that money out through a dividend. It doesn't create an extra layer of tax. And as long as you've got a reasonable level of payroll, I don't think you'll ever have the first issue. I've had clients audit this, and we've never had an issue. But we also insist that our clients do the payroll. Is it reasonable to earn $100,000 as an S corp and pay a $20,000 salary? Maybe. I'm personally not comfortable with that level of pay. We would probably target half up to the Social Security cap or something like that. So if you have 100,000 S corp income, 50,000 in payroll, to me, is easier to justify. So I have up here, though, payroll compliance implications, because what happens when you put yourself on payroll is all of a sudden subject to a brand new set of rules. You've got to do monthly tax deposits in most cases with the state of Mississippi, weekly, monthly, or quarterly tax, or on all those quarterly tax deposits with the IRS, quarterly tax deposits on unemployment, and you've got monthly and quarterly tax filings with Mississippi and the IRS, as well as W-2s. So we don't recommend this to someone who is a short timer in the industry, whose income is all over the board year to year. We only recommend this strategy to established realtors who, you know, love it, want to do it, you know, for several years, 5, 10 years or so or more, and who have a pretty steady level of income coming in, because you don't want to feel obligated to a payroll level you can't sustain. And also the tax savings has to be high enough to make sense. So that's why someone starting out, we don't recommend this strategy. Unless you're just killing it at, you know, you get a big property management group that's coming in and buying houses or something. They make sense. But for someone who, like a lot of you starting out, has relatives who might need to sell a house or whatever, this is not a day one strategy, in my opinion. We don't recommend it until there's a steady stream of income, a history there, and true tax savings.
What amount you would recommend to start with that, the comparison between the self-employment and sole proprietorship and S corporation?
Yeah, I would say, you know, I would say your net earnings need to start approaching $75,000 to $100,000 before I would even consider this strategy.
Okay.
And consistent earnings, you know, in other words, you have a great 2020. Let's see. Tommy, it's advancing on the computer, but not on the screen here.
Your company doing that too? All the payroll and all that?
No, we don't do payroll, actually. We refer that to third parties who do it a lot more cheaply than we do. Guys, give me just a second here. I think maybe this stalls out or something. Goes to sleep, maybe. Again, for those on Zoom, the question was, what level of income would we suggest before you start considering the S corp? And I said about 75 to 100,000 or so. See, it's doing it on the screen.
It is doing it on the
On the
screen.
computer screen, I mean, yeah.
Yeah, but it's not there.
Any other questions about S corp? That's a lot to cover. That's a big topic, and that's one of the more common ones. Okay, I'm going to keep going just because we are about 20 minutes left, and we'll catch up on the slides. I'm going to cherry pick here for a second. So next, I was going to talk about retirement plans. Now, you know, one of the reasons we love retirement plans in our office in terms of recommending them is because you're paying yourself. I don't like telling our clients to go buy a car to save taxes unless they need a car. I think that's bad planning, personally. We try to think of cash flow and not just tax savings. If we just saw the tax savings, we'd go tell you to buy it because the tax laws are structured to promote purchases of big assets. We think cash flow because we want our clients keeping more of their money over time. And sometimes the best way to do that is by paying the taxes versus going on and spending money to buy a big truck or taking on debt to buy a big truck that you don't need. If you need a vehicle, that's when we want to get involved and say what makes the most sense. I love retirement planning though, because you get a deduction and you're paying yourself at the end of the day. I call it your future self, of course, because there's restrictions on these funds. It's not like a bank account where you put it in an IRA or SEP or some of the more common ones, and you get to take it out the next year if you need it. That money's locked up in theory until about age 60. If you pull it out before age 60, you're going to be subject to a 10% penalty rule. But it goes in the account, it grows, you get a tax benefit the year you put it in. Some of the more, so you see here, tax deduction that pays you in terms of advantages can be made year after year end. That's a big one. So oftentimes I'll have someone ask me in May, what can I do for last year's taxes? And the answer was, see me in October. It's too late, you know, unless you got a time machine, you're stuck. But that's a very common question. I hate giving that answer. And of course, I put it a little bit more politely than that. But that's the truth. Retirement income can lower your income and make you more eligible for that QBI deduction, that 20% income exclusion I mentioned earlier. Back to this one though, about being made after year end. You can contribute to an IRA in April and still get a deduction for last year. You can contribute to a SEP, which is specifically tailored for self-employed individuals, as late as October 15th and get a deduction for last year. So if you are like I am and extend your return and you're filing in August or something like that, and you're looking for an extra deduction and you've had a good year today, you've got some extra cash on hand, a SEP's a great opportunity to make a contribution, get credit for the prior year, and do it as late as you file your return. If you file your return in April, you can't make it in October, but if you extend your return, as long as you make that contribution, either by the time you file your return or by the due date, then you, by October 15th, you get that credit.
Are there limits?
There are limits based on the income. All of these accounts have limits. IRA, I think the limit for anyone under 50 is $6,000 contribution for last year. If you're over 50, I think it's 7,000. Yes, ma'am.
Is there a implication if you converted to the S corp?
There is. I'll touch on that here in just a second. So SEP, you can contribute up to around $56,000, but it's based on your income. You can't contribute more than 20% of your real estate income to a SEP. So if you had $100,000 in real estate income, you can only contribute about $20,000 to the SEP. Still, the ability to make that kind of contribution, get a tax write-off for it, and do it next year is highly attractive. I will say on these retirement contributions that they don't lower the self-employment tax. This is just an income tax idea. That's why I have tax address here as income tax. And to answer your question, not all of these plans work with an S corp. On a SEP, for instance, which is the one we recommend the most to our realtor clients because many of them are self-employed sole proprietors. and it's an after the fact or hindsight opportunity to make a contribution. When you're an S corp, you're limited to contributing what your salary was, and it really needs to be on a deferral basis. In other words, you get paid, you send money to the account. You could still go backwards and do it, but it's not as valuable. But we will often recommend, the other problem with the SEP, especially with an S corp, but in any structure, is if you have employees. So if you're a broker and you have employees in there and you're structured as an S corp or even as a sole proprietor, whatever you contribute to a SEP for yourself, you have to do for them. That's why we don't recommend a SEP if there's any other employees. Instead, we'll recommend what's called like a simple IRA, where you can contribute up to $14,500, I think, for this year, if you're under the age of 50, and match it up to 3% of your income. You have to offer that to your employees, but if they don't participate, you don't have to contribute. And your maximum contribution for them is 3% of their earnings. It's a little bit more detail there than I want to get into, but I'm just saying this is not a one-size-fits-all except the S corp. This is where I meant about how some of these rules or ideas work against each other. If you're a sole proprietor, no employees, the SEP is a great way to go, or an IRA. If you're an S corp, we tend to recommend a simple IRA as a way to go. And in many cases, you can come close to the same contribution level you might be eligible for the SEP. Either way, under any circumstance, regardless of how you're structured, we certainly suggest you consider the retirement contribution. Just know, like I said, disadvantage, you're basically locked up until about age 60 without a penalty on that. Any questions on that? Realtor humor. We made fun of accountants. Let's do realtors now. Did you hear the guaranteed way to make $1 million, to have $1 million in real estate? The old punchline used to be you spend $2 million. Now I think it's you sell rental property to a hedge fund based on what I'm seeing. So,
That's right.
all right, you have a gun with 2 bullets, and there's a lawyer, an appraiser, and a realtor. What do you do? 2 bullets, 3 people. What do you do? You shoot that damn attorney twice. I had to be careful. There's appraiser in the room. That could go either way. So, other ideas. Children on payroll. Now, again, if you have kids, particularly if they're under the age of 16, this can be very beneficial. Because if you put a child on payroll and they're doing something for that, it's not just they're coming home and doing the homework, they're on marketing flyers. If it's like my kids are cleaning the office every couple of weeks. They're putting signs out for you. Marketing flyers is one of the biggest ones we see. They're on the website, something like that. You can have a child on payroll. You can, in theory, pay them up to $12,000. We do not recommend it being that high. But none of their income will be taxed because it's under this deduction level they're eligible for. And if they're under the age of 16 and you're a sole proprietor, you don't even have to pay Social Security and Medicare on it. So if you have a child who helps put out signs or who's on flyers or brochures or marketing materials, and you're paying them $6,000 a year, you've all of a sudden moved $6,000 of your income that may be subject to as high as 40–45% taxes to 0. That's a huge opportunity, particularly the more kids you have. Please don't use this. I'm not endorsing going and having kids, although I love my 2. I don't think I'd love 3.
What if they don't want to work?
That is it. I'm going to send you to the parenting class in the hall on that one. So, kids can also set up retirement accounts. So if you put the income in there, you can set up a Roth IRA for them, and they can pull that out down the road for the first time purchase, down payment on the first time house, for their college tuition. Kids have a lot more flexibility on retirement accounts than we generally do.
Is it just your kids or what?
You can put any child on there.
Anybody's kids?
It can be, I've got someone who does it, nieces and nephews. They help with the business. I'm saying that's my.
Under 21 or 18?
They can be any age. Now, once they get above 16, in almost all cases, you have to pay Social Security and Medicare,
Okay.
which is about 15%. So it's less valuable of an opportunity. If they're being taxed at effectively 15% and you're being taxed at 40, yes, there's still savings, but not as dramatic. IRS scrutiny as a disadvantage if they're not reasonably paid. If you got a kid who cleans your office once and he's getting $7,000 or $8,000 in income, and the IRS ever questions that, they're probably going to say that is, $7,000 hourly rate. Everybody's going to apply for that job. you know. And additional compliance costs for payroll. So back to what I said earlier about if you put yourself on payroll, all of those filings, if your kid's on payroll, you still have all those filings. So I don't recommend this usually unless someone already has payroll established, or they're looking to establish payroll like with a real estate assistant or something like that. Again, these aren't one size fits all. That's not to say there's not still tax savings there, but we don't want our clients spending more on compliance, you know, just to save money. If it's already, so if it fits in well, if you already have payroll, if you're an S corp or something like that, you're already on payroll, you have an assistant on payroll, this strategy makes a lot of sense. If you have 4 kids and you can justify enough earnings, you can still set up the payroll. I have clients who aren't on payroll but have their kids because there's enough savings there to justify it. But that's one of those things we always say, at least review and make sure the compliance cost doesn't outweigh the benefits. Okay, let's do it again, Tommy, on this. The computer's advancing, but not the screen here. Okay. So you want me to just plug everything in and out real quickly one time, or?
Yeah.
Yeah, no.
It's something with the actual, I think, projector software.
So I'm going to move on from that. We'll catch up on the slides for anyone taking pictures or whatever. The next one I was going to talk about is rental real estate. So generally speaking, that's buying a house and renting. You've got clients who've done it. Many of you may already own properties yourself. I often tell my clients real estate isn't always the best tax strategy. It's a great investment opportunity. We promote it in our office as an investment and a wealth building opportunity more so than a tax opportunity, because you're hoping to rent something to make money. You know, we don't like to tell our clients to go into something to lose money to save taxes. That's back to thinking cash flow, not just taxes. That said, if you have a year, for instance, where there's vacancy, not an issue right now, but if you do, or you have turnover and you've got big expenses to rehab a property, that year that property may have a loss. Well, for most taxpayers, that loss can be limited based on their income. That's not the case for you guys as real estate professionals. Real estate professionals can deduct rental losses no matter what your income is. So that's why I have it in here. It's a great opportunity for real estate professionals. First of all, you're tied to it, you understand real estate, you're seeing opportunities with it. But the fact that if there are losses, you do get the chance to deduct them without limit. Also, depreciation, writing down the value of the house. You get a deduction for that. That's available to everyone. But sometimes depreciation will swing a cash flowing property to a tax loss. You'll get that deduction opportunity. The one disadvantage I listed is I said it may produce taxable income, and I asked, is this bad? It may be bad for taxes, but again, we don't want to tell you to go, pour money into a black hole. We think in our office making money is a good thing. We can help you save taxes, we will do it. But we also want you investing and making money as well. So yes, it may produce taxable income. Congratulations, you bought a good property and you're making money on it.
Hey, James, can you go over what happens if you depreciated that house out over 27.5 years?
Yeah.
What the tax implications are once you sell that property
Sure.
because you use the depreciation?
Sure. So basically, Amy brought up a couple good points here. When you depreciate a house, basically what that means is you buy a house, the IRS will not let you write off the cost of it the first year. They'll give you 27.5 years to write it off. So for simple math purposes for me, if you have a $27,500 house, you get a $1,000 a year depreciation write-off. After 27.5 years, you've written off the cost, that deduction goes away. When you go sell that house, this is very similar to what I talked about with the vehicle and writing off the cost of the vehicle. Whatever money you sell that house for is taxable. The taxes, though, are determined by taking the sales price of the house minus the cost of the house. But then you also have to subtract the depreciation. So back to my fictional example of a $27,500 house. You buy it in 1980 for $27,500. You've expensed all of that through depreciation. It's now 2020. What is that, 40 years later? So the effective cost of that house is zero because you've written off the cost over 27.5 years. So you now sell that house for $127,500. Your first thought is, well, my gain's only 100,000. No, it's that full 127,500 because whatever you depreciated, it's almost like you have to add that back to the sales price, essentially is how it works. So depreciation recapture again is the term, it's a real issue. We'll see issues with this with clients who may have refinanced the houses a lot and they've owned them a long time. They may have a much larger tax gain than they have cash flow gain. That's why we suggest run these calculations before you want to sell property you've held a while, because it could be a disconnect. But I still think it's a good tax opportunity for realtors, and I also think it's a great investment opportunity.
Again, on that, for selling properties like that.
Yeah, okay, good question. So what was asked is, can you do a 1031 exchange on real rental properties? And you can. So what a 1031 exchange, or you may have heard it as a like-kind exchange, is you go and sell a property you've owned that was a rental property. You can go buy a new rental property, or a beach house, or a lake house, or land. As long as it's kind of business use, you can't go buy a personal second residence unless you're renting it. You got to thank you. So the benefits of that are that gain that you would have paid is deferred. It doesn't go away. It's deferred into the time when you sell that next house. But that deferral is very valuable because you're just not paying taxes on it now. This strategy works real well for clients who want to hold properties. Or like if you want to sell in DeSoto County because property values are through the roof and go buy in Anniston, Alabama, where they're not as valuable, the like-kind exchange can be great because you're not looking to get out of real estate. You're just looking to capitalize on hot prices in one market and move to lower prices in another. The like-kind exchange is a great strategy there. We have clients come to us wanting to do it just to avoid taxes, and we have to give them that warning. Taxes don't go away on this. It's just deferred until you sell that next house. Now, that doesn't mean you can't do a like-kind exchange on property 1 to property 2, and then from property 2 to property 3, or so on and so on. But it's a long-term investor strategy more so than just a pure tax strategy.
The taxes that you pay on gains, if you sell it 50 years down the road, are basically it's a long-term capital gains, and then whatever your tax bracket is.
Yeah, you still would have some depreciation recapture there, but yes, it's at that time, so right now, tax rates are at a historical low. And that's the other warning we give clients on this strategy is don't always count on them being this low. So again, if you're buying a replacement property, you're thinking you may sell that one in 2 or 3 years. In my opinion, this is not the strategy for you. If you're buying one, you want to hold the next property for 10, 15, 20 years or whatever, it's a great strategy. If we had more time, I'd talk about inheritance. That's a good way to transfer real estate, but we don't have the time for this. I'll have to come back.
Do you think the cash out would be the best way then? Instead of
I
selling?
got to say, it depends on a lot of factors. How much debt's there, what you plan to do with the money. Do you want to continue investing in real estate? It's not a one-size-fits-all answer necessarily. Back to rental real estate, another thing we're suggesting is what's called a cost segregation study. You may have heard of these. Basically what that is an engineering group comes in to a new property you've bought, and they're going to analyze the components of the property and say, well, this is the number of dollars is subject to, this was plumbing fixtures, this was kitchen cabinets, this was flooring. The reason that can be valuable is, if you remember, we said the depreciable life of a house is 27 and a half years. In other words, you get a deduction, but it takes you 27 and a half years to recover it all. Well, the engineering study can shorten that, in some cases, components of a house to 7 years or 15 years. So cabinets, for instance, we would think of that more as a 7-year property. So instead of having to take 27 and a half years to write that off, you may recover it in 7 years. And right now, in the current rules, you also have the option to deduct 7-year property, 15-year property the first year. So like the car, where you could write off the value of the car under certain circumstances the first year, you can write off part of a house the first year instead of over 27 and a half years. Where that's really valuable for you guys is that what I talked about earlier about your losses not being limited. So if you have a loss in real estate, some of our clients may earn over $150,000, which is the cap for deducting losses on real estate. They can't take that loss. It rolls forward to the next year. You guys don't have that cap. So if you accelerate your depreciation that first year through a cost segregation study, and you generate a pretty large loss, you have the ability to deduct that loss. The negative, of course, is the faster you take depreciation, if you go and sell that property, you're going to have more of that recapture, more of that income down the road. So again, this is a long-term real estate strategy more than just a 2 or 3 year deal. Flips are not eligible for this. You're deducting it all at the time of the sale anyway. Another idea, just briefly, because we're running out of time, LLC ownership. If you have your rental property in an LLC, you and your wife own it, and you've got kids, you can transfer part of the ownership to the kids without any taxes. And what you've done is you shifted income that's taxable to you to your kids, where it may not be taxable, or it's taxed at a much lower rate. This can be a good strategy. It could be fine. There's no real set percentage. You can make your kids a majority owner. The one thing about it, oh, and I have your create possible college tax credit eligibility. Your kid when he's 18 going to college, this income may be enough for him to claim himself as independent and qualify for college tax credits you might not be able to receive because your income's higher. One thing here though I have is the child is entitled to a percentage of everything. So if you sell that rental property and your child's a 5% owner, they're entitled to 5% of that net income as well. Or what we see sometimes is you did this when the child's 10, they get married, you can't stand the wife or spouse, and age 25, and you're in, I've seen a tragic situation where a child died, and now the parents are in business, so to speak, with the surviving spouse who married into the family, and they're having to buy the spouse out. So again, all of these come with caution. That's why I have to say, these are all good ideas, but it's got to fit your circumstances. It's not, they don't walk out of here and go transfer LLC ownership to a 19-year-old who's dating someone you can't stand. I know but I mean, I've seen the bad sides of this, and it gets to be a little harsh. So tips and to-dos, we're running short here, but record keeping, that sounds obvious. But no offense, you guys are terrible record keepers. I've seen it, I know. That's not to say everybody is, but,
We're not bookkeepers.
huh?
We're not bookkeepers.
Yeah, but if I told you to say $5,000 a year in taxes, you probably become one. But what we see are clients who are missing deductions because they don't know what they spent. So even if you, and please don't throw them in a shoebox, receipts, and bring them to anyone's office. Because I'm going to tell you, there's such and such up the street, go talk to them. But a spreadsheet, it doesn't have to be QuickBooks. It doesn't have to be Quicken. It doesn't have to be a software. We usually would run out, tell our clients, track it in a spreadsheet, enter it once a week or whatever. We're not trying to make you bookkeepers because we know it's a pain, and we don't want you to spend so much time tracking expenses that you're costing yourself money. But we know there's money being left on the table with our clients because they're not keeping great records. Think cash flow. That's what I was saying earlier. Don't just go in trying to save taxes. Sometimes, and I have clients who want to shoot me, but I say, you're going to keep more of your money paying your taxes than you will if you go buy something you don't need or take on a $50,000 car loan that you're obligated for when your other car was just fine. That's why we try to say, let's talk about you keeping your money and what that looks like. And usually that's going to be a combination of strategies. Some tax planning, some purchases, some retirement, and then some paying taxes. January's too late. That's back to what I said. If you come to me in May and say, what did we do for last year? I say nothing, other than maybe a retirement plan. Estimated tax payments. Again, we recommend these. You're not saving any taxes with these. You are saving penalties and interest. You're supposed to make 4 quarterly estimates a year if you're not an employee on your income. If you don't make them, you're not going to get in trouble. The IRS is probably thrilled because you're going to pay them more interest and penalty on the balance that you owe. So it's not like you have to do it, but we recommend it. Why pay the government any more than you have to? That's all I got, other than one final joke. And then I can take any questions. We're running a little bit long, but I've got a few more minutes. Just so you know, in my office, the IRS is not a bad word. It stands for I'm really sexy. That's all I've got. Any questions or anything like that?
Then the business credit card would be handling this good for bookkeeping.
We suggest all of our clients have separate bank accounts and separate credit cards for their business. Try not to mix the personal and the business if you don't have to. And now, again, if you come to me with credit card statements, we're still going to say you need to sum up. But it's at least all there in one spot for you as opposed to trying to go find all your receipts.
You have a credit card, they have the breakdown.
Yeah, but those breakouts, like it'll say merchandise purchases. That's not IRS. We can't put that on the tax return. It's not going to be specific enough. Yes, ma'am.
You probably know, but if everything is 60 or under,
what happens to us, I know retirement is not where retirement, but when you make money, you tell somebody else.
You can still do retirement plans. The reason I say 60 and under, I mean, is because you can't pull that money out without paying a penalty. But we got plenty of 60-plus-year-old clients still selling real estate or doing plumbing or whatever, and they can still participate in a retirement plan. And you can then pull money out and not pay penalty, but you're gonna be taxed on it. So it doesn't make sense to pull money out of a retirement plan and put the same amount in. It's gonna be a wash. Now, when you get to age 71 or so, it's a different set of rules. At that point, you have to start pulling money out of a retirement plan. And we don't recommend retirement plans, but we've got clients who are over that age still working. Let me tell you, I'm gonna be working then, and my wife will shoot me if I'm home that much. So,
Any recommendation?
you know, I've got to be careful because I'm not licensed. I would say the rental property's great, and I got an accounting firm for sale. No, just kidding. but no, I mean, an IRA though is usually just one thing I will say. It's going to give you an opportunity to put money in a lot of different mutual funds. I'm not that savvy. I don't follow the stock market every day. I can't tell you go buy Microsoft. I'm just going to, to me, because if you don't really know what you're doing, you might as well go to two. So that's why I put it in a mutual fund and try and hope they know what they're doing. But in terms of specific recommendations, I don't really have that.
Okay.
So, any other questions?
You do tax in Puerto Rico?
I do not do Puerto Rico taxes. No. We might set up an office there, but I don't have one yet.
That's what a lot of my guys are going out there to pay only 4%.
Yeah, but if you're a US resident,
Yeah, you have to be there over 6 months.
yeah, there's a lot of fine print there, but it's hard to sell real estate in DeSoto County from Puerto Rico. That's one thing I'll say. Any other questions? Guys, thank you very much. I appreciate it. One note, I know this is several, we are in my office not taking new tax season clients right now. So I do have my information up here. We're happy to help after tax season, but we're maxed out. So for any of you who are already clients, congratulations. But we are not taking new clients at this time. You're welcome to reach out to us for questions. We'll do what we can to answer, but we're in our busiest time of year. We're happy to talk to you in the summer if you'd like. Thank you.
Okay.